In terms of the risks around an escalation of a trade war, this is one of the sort of scenarios that you see as more of an outlier, among other things, a 20 to 30% probability of risk. How do you see this evolving?
Well, I think that the market consensus is actually, in this case, valid, which is that the administration, President Trump in particular, are using the threat of tariffs as a bargaining counter in order to get other things. It was very interesting when the steel and aluminum tariffs were announced, what, 3 weeks ago or 3 or 4 weeks ago. You had the photo up in the Oval Office with the steel workers. You then went straight to Mr. Trump's comments, in which he walked back the tariffs almost immediately. He said, Canada and Mexico are our friends, we won't target them, and the Germans might get better treatment if they pay for their own defense. So in other words, using the tariffs as a threat to actually get other agenda items. Now, my 20 or 30% probability is that others call his bluff, and we end up by default with a rather unintended trade war. But I don't think that's the course that they think they're on. And I think that some of the more free trade-oriented heads within government, you're talking to Larry Kudlow later in the day, I think many of them would actually sympathise with the idea of using tariffs as a bargaining counter.
So you're buying very much into this argument that this is posturing and this is not where we end up then, Jim. But things do seem to be escalating pretty quickly, don't they? I mean, the market's just getting its head round the 50 billion versus 50 billion for the two countries. And then we get this announcement overnight that the Trump administration wants to investigate the possibility of further tariffs on another 100 billion of Chinese imports. I've got this chart, 7861, which shows that actually it would be very difficult for China to match this toe-to-toe because of the scale of the imbalance in deficit. It would be difficult for China to find enough US imports to then match this. So it begs the question how China then retaliates. What other tools do they have in their toolkit? I mean, I wonder whether we need to get to a point where we've got a date in the diary, an announcement of a meeting, some kind of firm commitment to negotiate something away from this posturing. Yeah,
I think the negotiation is happening behind the scenes anyway. I don't think it necessarily needs President Xi to go to Mar-a-Lago for the two sides to be talking. I think there is quite a lot of conversation going on. Having said that, it's not yet decisive and constructive conversation. And I think that's something that the market expects to develop over the next few weeks. You probably will see some sort of head of government type conversation between the US and China, but it needn't be imminent. The conversations can happen, the concessions can be made at a lower level and get ratified later. The market thinks that's where it's going. But, you know, it's so political. If you look at what the Chinese retaliation was, you know, soybeans and pork, that's aimed at the people who elected Trump. It's not aimed at the US economy more broadly. And so it's highly politicized when you look at the specific targeting of tariffs that's been suggested. And I think that's the clue to what's really going on. But there is this 20 or 30% possibility that bluffs get called, things degenerate. And that would be very bad for the market and quite bad for the economy.
Yeah, and Jim, you sort of advised to not really adjust your portfolio based on that 20 to 30% probability. But before we get to there with what's happening now, we've seen a lot of equity volatility, more volatility in equities than in other asset classes, as we've talked a lot about this week. I just want to take you to a chart which shows the relative performance of stocks versus bonds. And that has actually come down recently. You can see towards the end of the chart, it's coming up a little bit. In the scenario that we're in now, before we get to that 20 to 30% probability, how would you allocate? Would you reduce your exposure to equities or not yet?
Probably not yet. I think in US equities, you should be keeping up to weight because, you know, the US equity market is, in terms of average rating, it's now on about between 16, 17 times current year earnings on the Standard & Poor's 500. That's about in line with the long-term average, at a time when the fundamental background is better than usual. You know, you've got the impact of the new tax code coming through. You've got at least the late stages of a synchronized global upturn. It's actually pretty good conditions for profitability and for the equity market. That's why I nervously say stay up to weight, even in spite of the possibility of some pretty nasty policy mistakes.
And you don't attach a very high probability to those policy mistakes, as Nera was saying then, Jim. But do you have a handle on what the end goal of the Trump administration is here? Is it about bringing down the deficit, as he talks about so often? Is it about a decent performance in the midterms? It seems that we need to understand on what basis he will rate his own success to understand where this goes.
And he measures his success very clearly by popularity among his base. And so what he wants to see, I suspect, is better job picture for his base, rising wages for the middle of the country, for the people that really elected him. And I think that's his ultimate aim. I think a lot of the anti-foreigner rhetoric is really just aimed at the elements in that who are anti-foreigner. And I think that, in a sense, that's the noise around a fundamental economic aim, which is to try to take away the decline, relatively speaking, in living standards among basically the white working class.